era of driving indeed. Well, inflation is still high, is at 22.22%, in spite of the fact that Nigeria's central bank has increased the interest rate 6 times. The interest rate was initially set at 11.5% between 2021 and March 2022. It was raised to 13% from 11%. As we speak, we're talking of interest rates at 16.5%. And in spite of this, we still see inflation surging. For April, we saw it. So now let's have Mr. Ayodiji Ebo joining us to tell us why he thinks inflation is still surging in spite of the interest rate hike. Mr. Ebo, good morning. Thank you for your time this morning.
Yeah, good morning, and it's great to be here.
Good to have you. So, I mean, in other countries, like even in the United States, we see the Federal Reserve hiking rates, and then we see like response in inflation. At least that's what we had the last time. But in Nigeria, it seems there's no connect between interest rate hiking and inflation numbers.
Okay, thank you. Before you would expect to see the effects, we need to first understand what the main reason for our own inflation. For the developed climes, mostly what you would see is more of demand pull. They have too much money in circulation due to a lot of the quantitative easing. And as a result, they felt to see how they can increase, contract or take out money in the system so that it will reduce demand. But for us in Nigeria, it still boils down to cost push, which means that more of it is more tilted towards structural issues, high production cost, and insecurity is also affecting demand. So the peculiarity of our inflation rate in Nigeria, it's totally different from what we see in developed climes. And that's why, as a result, that despite increasing MPR 6 times, we've not really seen that impact on reducing inflation rates. For instance, when you look at the cost of moving food items from the north to Lagos, is significantly high. We are paying for those inefficiencies, and it's impacting on prices. We also should not forget the impact of FX, how it fits in, looking at where most businesses get their FX from, which is the parallel market. That has also impacted. Imported inflation, when you look at it, forms, I think, about 30% of total basket. So it's really more cost push than demand pull that we have in developed climes. That's why we are seeing that impact. But then the more they increase the interest rate on their mortgages goes up, interest rate on their fixed income goes up, and as a result, you see a bit of alignment that people will prefer to save rather than spend.
So what should Nigeria be doing if we really want to tame inflation?
Okay, thank you. I think if we're able to, I mentioned some of the causes. One, we need to first tame insecurity. So we have less production of food in the food producing areas because of insecurity. So if we're able to take care of that, that will increase production, and it's also a demand and supply. So if supply increases, then we will see that the prices will fall. Secondly, we need more stability in FX. That's, we can say, maybe long term, because when you look at all our channels or sources of FX have dwindled significantly. We are not getting FPI, that's foreign portfolio investors, foreign direct investments, oil proceeds, euro bonds have all dried up. So the CBN trying to create stability is really going to be a very tough one. So if we need to be able to produce more for us and export more for us to create that stability, that may be more long term. But if we also fix our infrastructure system, so moving goods from Kano or from the up north to the east or to the west, if we can be done via train rather, then that would also reduce the cost. The cost of using trailers or trucks to move them can really be very high, and a lot of the inefficiencies that you have to pay, different tolls, that you have to pay on the road. So that is part of what is compounding our issues. So if we don't take care of those structural issues, transportation, diesel prices that continue to also go up at that expense, then it will continue to see that impact on prices.
So what happens if the CBN or the MPC continues to hike rates, and yet we see inflation surging? Is that what they call stagflation? Or what's the picture? Because it doesn't look like CBN are ready to stop that, as long as, you know, even countries like the US keep on hiking rates.
Yeah, so I think that if the CBN or the MPC, Monetary Policy Committee, keeps raising the rates without the complementary factor or support from the fiscal authorities, then we're going to see more negative impacts because you see, for most businesses in Nigeria, when they take loans, one thing that you see is that it is floating based. For those that take fixed loan, maybe the blue chip companies that borrowed borrowed using bonds, they may not be impacted. But when you look at SME, account for a major part of businesses in the country. So that would impact on their cost of finance, which will also impact on cost of production. We also see that there are other factors that are impacting on fixed income yields. So you would observe that despite that increase from like an average of about that 12% to almost 18% now, we've not seen that corresponding increase in the fixed income rate, because liquidity also play a major role. The tenor of those instruments play a major role in determining the yields on this item. So I believe that the MPC will get to a point that they will need to allow the fiscal authority to come in and around improving on ease of doing business, which is working on the structural issues to complement the effort. Because what the CBN is focused on is trying to see that if they're able to increase interest rates, yes, interest rates on savings have been going up, it will reduce people from spending because they want to save. Secondly, it also reduces the pressure on exchange rate, because the more you try to also increase the rate, the less maybe speculation on the exchange rate, which creates a bit of stability. But I don't think the increase in the MPR is the silver bullet for solving this problem.
Okay, so now we have a new administration coming in, and you did talk about the issue of infrastructure. You talked about the train, which we know, even though there's been attention given to it in recent times, it doesn't just happen. There's still processes already. A lot of the debts, China loans and all of that, are connected to infrastructure. And we're already using about 90% or more to service debts, unfortunately. So when we look at this tight corner that it seems the economy is at, it's not simple. You can't just raise rates and expect that inflation will be tamed. We need to deal with infrastructure. We need to align the fiscal and monetary policy. It's a lot of work, obviously, awaiting the president-elect, who is supposed to be sworn in a couple of days. But where can they start from in reality?
Okay, thanks. I think the first step is trying to review the PPP arrangements. They need to be able to come up with or rejig that policy that will create a bit of comfort for the private sector. You rightly mentioned the government, in terms of revenue, is challenged, and there's no need trying to be raising bond to finance this. They need to try and partner with private investors. Sometimes we have that perception that, oh, things may look more expensive, but we are paying for all these inefficiencies. So if the private sector can build the rail within the next 2 years across all the nations, and we have to pay high toll so that they can recoup it, it will still be lower than using trucks from the north to the east. Because there are even a lot of invisible tolls.
Mr. Ibo, but I mean, when you talk of PPP, we have the credit tax scheme, We have a lot of PPP programs already in existence. So what's happening to those ones?
Yeah, so thankfully that you mentioned the credit tax system, which we can see that impact. The Apapa to Ojota Road by Dangote, there are a lot going on, but we now need to see how we want to encourage more of the private sector taking it. Getting those approvals to sometimes may not be as straightforward as we think. So if government, the private sector are willing to support this, because they also suffer it at the end. If we can ease businesses, if roads can be better, then it will also reduce even manpower being spent on the road. So I feel the focus is now implementing those policies that would create more level playing ground for private sector. Government, we can see Lagos, Ibadan, almost 10 years still under construction. If it has been, if it was well handed over to the private sector, but those that have the capacity to build it, in less than 2 years, that road can be done and it will save a lot of time. So I believe that there's more collaboration. There needs to be more collaboration with the private sector. We need to respect contracts, which will provide confidence for people to bring their money, and they see how they can also recoup it. And for also Nigerians, because of that perception, because the stakeholders' engagement are also very key, that some of these things should be provided by the government, and as a result, they don't need to pay for them. Indirectly, we suffer those inefficiencies, we pay for them. Some of the invisible tolls that we see on the road that you cannot account for, we definitely pay for all those things. So if we're able to get private sector come fix some of these program, infra code that has been set up, we're believing that would also play a major role in easing infrastructure in this new administration.
So what do you see the MPC doing on Wednesday? Their meeting begins tomorrow, ends on Wednesday. What do you see them doing? You see them holding, hiking?
My bet is that they would hike by about 0.5%, so from 18% to 18.5%, given the stance of the CBN on inflation.
And of course, that's higher operational costs for those SMEs you talked about earlier. But anyway, we'll see what they'll do on Wednesday, and then we'll discuss the expected impact. Thank you so much, Mr. Ayodipo, for your time this morning.
Always my pleasure. Thanks for having me.
Yeah.